Hello and welcome to this Monday's weekly market briefing. We've got lots to talk about, but firstly, Russia dodges G7 price cap and avoids Western sanctions on its most expensive oil exports, and this is, what provides the most revenue to the Kremlin. As well as that, US auto strikes expand across the nation, with the possibility of Joe Biden joining the picket line with the US auto workers protest. As well as that, US and China attempt to strengthen their ties and stabilise tensions by forming new economic working groups together. And finally, hedge funds lay off and reduce their bets and shorts against gilts as gilts continue to rise. But we'll come to that near the end. And finally, we've got lots to talk about on the charts. US indices are in a really interesting place, after falling last week. As well as that, gold's in an interesting place along with the dollar. And finally, we've got lots of economic news that's coming out this week, economic data coming out this week, and we'll talk about that at the end on the economic calendar. But firstly, to talk about, of course, is Russia avoiding sanctions, with Russia dodging the G7 price cap on most of its oil exports. Now, Russia has succeeded in avoiding G7 sanctions on most of its oil exports. This will boost the Kremlin's revenues as crude rises towards $100 a barrel. And this is what we've been talking about a lot recently, is the price of oil, because as we know, Russia and Saudi Arabia have been cutting their oil supply in order to push for $100 a barrel oil. Now, we've been talking and speculating about why this might be, why the Kremlin and Saudi Arabia are actually trying to do this, with the possibility of the attempt to oust Joe Biden from power by causing excess inflation in the US, which causes disdain for his presidency, and the various reasons why they might do that. Now, almost 3/4 of all seaborne Russian crude oil flows, travel without Western insurance in August. Now, this was a lever basically used to enforce the G7 $60 a barrel oil price cap. And this is up 50% from spring, implying that Moscow is more adept at circumventing the cap and allowing Russia to sell oil prices closer to an international rate. So basically what they're trying to say here is what the Western countries were trying to do after Russia invaded Ukraine was essentially place a $60 limit on the price of oil if any Western oil cargo ship basically was used. And as a result, with the Western insurance and that sort of thing is what made the cargo ships Western. However, what Russia is basically doing now is not insuring their cargo ships with this Western insurance, and thereby not having to keep the oil prices to $60 a barrel, and actually being able to exploit the high prices that oil is currently seeing. Now, this, along with the increase in crude oil prices since July, means that that the country's oil revenues are likely to be $15 billion higher for 2023 than they would have been. And so this is kind of telling the tale that sanctions really haven't worked out how they are intended, because in effect they're sort of helping Russia in terms of its oil revenues, and this is all a large blow to the Western effort to restrict Russia's revenues from oil, which makes up the largest part of its budget, because as we know, Russia is an oil-rich nation with lots of other natural resources, but oil is a large part of their economy. And so whilst Russia's oil sector is facing several challenges, the figures will still suggest more oil revenues will be flowing into the Kremlin's war chest, which obviously will be aiding in adding extra funding into the war in Ukraine. Now, This is also a danger to other countries in terms of, how effective really are price caps, and also provides the risk of what extent can they really be used in the future. Russia also this week banned the export of diesel and other fuels, sparking fears that Putin will disrupt the oil market as he did with natural gas. And we understand that, when he did disrupt the natural gas market, it had international effects on, US consumer markets, with the ability to essentially get, pay for your electric and heat your home went up exponentially, which caused, Europe's massive inflation spike. Now this is also now the provision of Western services such as shipping or insurance is allowed under the price cap, but only if the oil is sold for less than $60 a barrel. With Russia once reliant on Western services to get its oil to market, the G7 calculated that Moscow would have little choice but to comply. And this is what I was getting to earlier, is this is kind of how it worked. Whilst, a lot of these Western nations, did ban, the import of Russian oil, they still let these cargo ships and insurance companies to function with Russia's ships. However, that was only allowed as long as they kept to this $60 a barrel cap. However, now they're just not buying the insurance, and so they're still able to, sell at these higher prices that international markets are calling for. With And as well as that, sanctions so far, however, since February 2022, have reportedly cost $100 billion in oil export revenues for Russia. So far, they've had a great effect on Russia, a great negative effect for Russia, it does seem. That said, however, with this kind of change in trade flows for Russia, where they're moving away from using Western companies for ships and for insurance, it will be interesting to see whether now that we won't see that negative effect on the Russian economy. Now Russia has built up a fleet of oil tankers able to operate without Western insurance. Moscow has been able to obtain higher prices for its oil as the global market has tightened, and we've been talking about that a lot with Russia and Saudi Arabia cutting supply, and as a result causing price to skyrocket. And finally, the diesel export ban announced on Thursday may temporarily hit Russian revenues, but it could lead to higher prices with lower volumes. But that's all for Russia. Next to talk about really is US auto strikes. Now, the United Auto Workers Union is expanding its week-long strike to additional workplaces owned by General Motors and Stellantis, whilst sparing Ford, which it said had dramatically improved its offer to workers. Now, Union President Sean Fain on Friday morning said the strike would spread to 38 part distribution centres across 9 states in the US. And currently strikers are picketing 3 auto assembly plants with 13,000 of the UAW's 146,000 members at the Detroit car makers. Now, Fair even asked Joe Biden to join the picket line, with Biden accepting on Friday and confirming his visit to Michigan next week. Now, as for why the US auto strikers are targeting these part companies rather than other areas of the auto manufacturing line, is largely because they're trying to focus on these companies not being able to repair cars which have already been purchased, and as a result you're kind of forcing a problem onto them in the instant, because as we know with car production, it can be a much longer kind of process, and a longer start to finish date, whereas when you're kind of fixing a car, it's a lot shorter, and so it's expected a lot faster. So if you're kind of preventing cars from being fixed, this would usually be a 1 week solution or something. That can extend to 3 months with these strikes, whereas with cars, you wouldn't actually see, with car production, you wouldn't actually see the effects until much later on, possibly. As well as that, this move in relation to Joe Biden, however, does risk alienating some voters in politically important Midwestern states of Michigan and Ohio, which don't kind of agree with this state of unions picketing and that sort of thing. Fain commented on the situation with certain employers saying, "We do not want to recognize that Ford. We do want, to recognize that Ford has shown that they're serious about reaching a deal," he said. At GM and Stellantis, it's a different story, however. And he also threatened, "We will shut down parts distribution until two companies come to their senses." Until those two companies come to their senses, he added. Now, the union is focusing on parts centers rather than other vehicle assemblies, which will make it harder for GM and Stellantis to repair vehicles already sold to customers. As a part of the negotiations, Ford did offer to reintroduce cost of living adjustments, Fain said, and helping workers keep pace with inflation. The union conceded such adjustments also in 2009 with Chrysler. So this is sort of what the UAW is looking for from other car manufacturers such as GM and Stellantis. But it'll be interesting to see whether they'll actually follow through with that. And since the start of the strikes, GM has produced 6.3 thousand fewer vehicles than it otherwise would have since September 15, and Ford has made about 4,500 fewer vehicles, and Stellantis has made 5,900 fewer. So a great impact on these companies so far, with the Deutsche Bank analyst Emmanuel Rosner estimated the impact on operating profit coming to 82 million at GM Motors, and 77 million at Stellantis, and 58 million at Ford. But that's all for the auto worker strikes. Next to talk about really is the US and China, with Washington and Beijing creating two working groups to stabilize economic and financial issues in the latest effort to increase engagement and stabilize the current US and China relationship. Now, we've been talking about the US and Chinese relationship a lot recently, and that's largely because of the amount of cabinet members within the US that have gone and visited China despite weakening ties. And these weakening ties have largely come from a foreign policy standpoint around Taiwan, and also China's relationship with Russia following Russia's invasion into Ukraine. And so we kind of saw all these members of the the cabinet visiting China, however, kind of warning of quite little effect coming of their meetings, and it more just being rhetoric, and we understand that largely because of Joe Biden, who's kind of banned a lot of investment opportunities into China, as well as funding Taiwan a bit more. And so this has kind of driven US and Chinese relations to a weird sort of standpoint, where a lot of cabinet members are going over there and talking to China and interacting with them, but at the same time we're getting this contradictory rhetoric from Joe Biden. Now, the US Treasury Secretary Janet Yellen and her Chinese counterpart Vice Premier He Lifeng will oversee the group. This comes 2 months after Yellen visited Beijing for meetings with top Chinese economic officials. Now, Yellen said the group would serve as important forums to communicate America's interests and concerns and promote healthy economic cooperation between the rivals. Now, it also followed a trip to last month by the US Commerce Secretary Gina Raimondo, who set up several new formal channels for dialogue. And the creation of this group is the latest sign that the countries are working together to move past the dispute that erupted in February when a Chinese spy balloon flew over North America before being shot down. And if you think back to that, Chinese and US relations were at all-time highs in terms of recent years, and so we were kind of worried about how trade might continue with those two nations. But I think it's also important to note how this will be seen and how this might play out going into the election year next year, with rhetoric from certain politicians being very anti-China. And so it'll be interesting to see whether and what will come out of that. Now, US and Chinese officials are in discussions about possible second face-to-face meetings if Xi does attend the Asia Pacific Economic Cooperation Summit in San Francisco in November. And this would come after Xi skipped the G20 Leaders Summit. And in addition to that, on the other side of that, optimistic news has come out of China, with Xi reportedly saying the country's joint fight for world peace could inspire them to help each other succeed and achieve prosperity together. That said, we're in an interesting situation with China across the whole of the Western economic sphere of influence. With the recent Chinese spies caught within the UK, we had the spy balloon in the US not too long ago, as we spoke about, and the kind of negative rhetoric which largely has been heard over the past year around China does make it hard to believe that anything good is actually going to come of this, and whether it will just more so be a kind of stamp on a piece of paper to say, look, we're working together, we're trying to make changes. It's whether things will actually change that matters. But next to talk about really is hedge funds and their rush to unwind bets against gilts. Now, hedge funds have been running to unwind bets against Britain's £2.5 trillion government bond market as investors become increasingly convinced of that the Bank of England is nearing the end of its rate rising campaign. Now, this is what we spoke about last week, with the very optimistic UK's inflation data coming out, which came far below what economists were predicting, as well as that, the Bank of England chose to keep rates where they were, which was a surprise considering that the week before it was predicted that the bank rate was going to go up. And so what came of that was ultimately the pound falling, but gilts rushing to new highs as money poured into gilts as people took their money out the pound, expecting rates to start coming down quite soon in relation to the Bank of England's rhetoric. Now, the total value of the UK's bonds borrowed by investors to wager on a fall of prices this week dropped below 65 billion pounds. Dropped below 65 billion pounds. The decline in short positions come as gilts have staged a comeback in recent weeks, following the data that I just spoke about, after having been one of the worst performing sovereign debt market in the first half of the year. And this is largely the fault of having high expectations for the UK's interest rate, which was expected by many to reach levels even of 6.5% by the end of this year. And markets are now pricing in a 60% probability of a one more rate rise to 5.5%. So it's even split on just a small rate rise, split nearly 50-50 by investors. And this would be by next year, having in June expected a peak rate of 6.5%. And this is what I was talking about in relation to what investors were expecting otherwise. And some investors, however, do think that the lion's share of the recent gilt rally may be over, with the Bank of England cautioning there was no room for complacency on inflation. And this is what we spoke about, last week in relation to the Bank of England's rhetoric, that although they were looking at keeping rates where they were, there still was no room for complacency on inflation. And just because there's 1 week some good inflation data doesn't mean that that's going to be the way it is for the rest of the year or next year even. But that's all for the articles really. Next to talk about is the charts, with the first kind of asset or market to talk about really being US indices, and in particular just US indices staying low. Now, last week we talked about how US indices sort of fell off as a result of the Fed's rhetoric about raising rates later this year, which came as a surprise to many which didn't expect that. And as a result, stocks sold off as people expected higher borrowing rates going into this, towards the end of the year and into next year. And this is what we've kind of seen across US indices with this fall off, especially around here, following the Fed's rhetoric. And so now on assets such as, the US 30, we are now dipping below lows of 34000, which is kind of, worrying for US stocks at least, because below that, the only other areas really we have of liquidity of other lows is areas such as this, which are quite a distance away from the charts, quite a distance currently away from price. So it'll be interesting to see whether price can actually make a run down to those levels, because as we spoke about last week, we kind of thought maybe this area of liquidity at prior lows may be used to make new highs, but it does seem, as we can see here, it failed to make any movement from that area and just continued a fall to the downside. So it does seem like it's a bearish position for US indices. But next to talk about really is the dollar, which has seemed to consolidate at new highs. And this is also largely based off the Fed's rhetoric, which many people started to price in instantly the expectations of higher rates, which were expected by the end of this year. That said, however, the dollar is consolidating at this moment, so it'll be interesting to see whether it will actually continue moving higher or it will continue consolidating, as it may be that the dollar has finally priced in the expectations for the interest rate. But that said, we've got economic data coming out this week around inflation, so it'd be interesting to see whether that will have a great effect on the dollar, because obviously inflation is played greatly into what the Fed how the Fed makes its decision around interest rates. But next to talk about really is pound yen, which is an interesting position around the Fibonacci retracement tool, because obviously we were in this kind of rally, an upward bullish trend for a while. However, it did finally break lower quite dramatically following the Bank of England's decision, breaking below this channel and falling into this area of liquidity before making a kind of retracement after punching that liquidity, where it seems like it's now broken, hooked, and is looking to fall further after hitting this 50% fib, as well as coming near this prior channel. So that's what I'm kind of thinking here is it seems like it's come down, it's pulled the liquidity, the buy orders that were sitting at these lows, tested for some short liquidity and is now looking to move lower after breaking and now hooking and now would go. But let's see how that turns out going into this week. Also to talk about is USD JPY, which is reaching this double top level. We've been speaking about dollar yen for a while now, and that's largely in relation to it continually making new highs. But it does seem that dollar yen has this sort of pattern of making new highs, double topping and that sort of thing, and triple topping even before continuing higher. So it'll be interesting to see whether it will fall from this area, or in fact it will break above, retest and continue going using this liquidity from the prior high. And also next to talk about really is Bitcoin, which is pushed into this area of liquidity and now is seemingly breaking below it as we speak, hitting the 50% Fibonacci retracement tool area. And we were kind of thinking optimistically for Bitcoin last week after it had reached this area of liquidity, after making new highs, after consolidating this area for a while. But it does seem that fundamentals are preventing Bitcoin from making new highs, and Bitcoin looks like it's returning back into this area of accumulation. So it'll be interesting to see whether these Fibonacci areas will have any significance in causing Bitcoin to make another run higher. But that, and also finally to talk about, is gold, which is an interesting short position really. Following the Fed's decision last week around rates possibly increasing by the end of this year, it's kind of a bearish position for gold, especially with the more positive news coming out of Chinese and US relations, and so it does seem like it's a short bearish fundamental position on gold. So I would be expecting downside potential from gold following last week's decision. And that said, it's currently sitting at a 38.2% Fibonacci area, so it'll be interesting to see whether it will make a short run from this position to the downside. But that's all for the charts. Next to talk about really is the economic calendar, with lots of economic data coming out this week, with firstly German business sentiment coming out, along with US consumer confidence coming out, US consumer confidence data coming out, as well as German consumer confidence data coming out. So lots of consumer confidence data coming out, as well as US durable good orders data coming out, along with the US GDP growth rate figure coming out, along with the US GDP growth rate figure also coming out, as well as the German inflation rate figure coming out, as well as the German unemployment rate figure being released, along with Eurozone inflation rate data coming out, as well as the inflation rate for France and Italy, which come in line with the Eurozone. And finally, we have US inflation data coming out. But that's all for the economic calendar. That's all for the articles, and that's all for the charts. I hope you're well informed going into this week's trading week on the 25th of September, and I hope you have a great week. Good luck with any trading that you might do this week, and yeah, have a great week. See you later. Bye.